Hello and welcome to this week's Ferrari Financial US Market News Summary. Well, we said last week that we felt the rally certainly had some steam left in it, and we were proved right. For the first 4 days of the week, there were very impressive gains on all the indices for the Nasdaq and the S&P and the Dow. In fact, the Dow has gained 900 points over the last 9 days, so a very impressive rally based on the change in perception from most investors that the credit crunch crisis, which is really the subprime mortgage problems, the tightening of credit, those problems are probably over their worst, and the intervention of the government, President Bush's statement on the plan to help mortgage borrowers that will find themselves in a little bit more trouble next year when the rates are revised. That plan going forward has certainly eased investors' worst worries. But is the credit crisis really over? We don't think so. We think the tip of the iceberg certainly has shown itself now, but we still feel there's a lot more bad news to come going into the new year. Let's take a look at the Nasdaq Composite Index chart and discuss the main scenarios that we see going forward. Here we're looking at the Nasdaq Composite Index chart for the last 3 years. The reason I want to look at this chart today is to really point out the importance of this long-term average line. This is the long-term average over these last 3 years, and the significant thing is that the market really for the last year and a half has been well above that average line, taking now 3 tries at breaking through the line, and each time bouncing back very nicely, and in fact reaching the October highs we've seen last month before the last selling period. The selling that happened a few months ago, of course, was when the first news of the subprime mortgage crisis broke, and considerable selling at that time took us virtually down to touch that average line. We now have another sell-off period going on. Last week, of course, we had a nice bounce back, with the feeling that the Federal Reserve may well cut rates again at the December meeting, but also a little bit more confidence that the financial sector is dealing to some degree with the financial crisis caused by the subprime mortgage industry. Now, the real question, of course, is whether this is going to be just a repeat of the pullbacks we've seen in the last year and a half or so, where this rally would now carry on upwards and go on to form yet one more high in this bull market that we've seen for the last 6 years, or whether, which is in our view more likely, that this is in fact the short-term rally which will be part of a right-hand shoulder forming out here of a head and shoulders pattern. This head and shoulders reversal pattern really is the left shoulder here, followed by the head of the pattern, which was in October, followed now by the formation of a right shoulder into the new year, before then, if the pattern does complete, the more likely scenario then is that the market will then drop down through the long-term average point at around about 2,500, 2,500 for the Nasdaq, and then possibly a longer term period of downtrend well into the new year. Well, if the head and shoulders scenario is proving to be the correct one, then the formation of the right hand shoulder is certainly well underway. Is there a much more upside before this shoulder is complete? Probably not. So going towards Christmas, the only thing that we see that could really make the upside much more prominent would be, of course, the Federal Reserve this coming week cutting Fed funds rates by 50 basis points instead of the probably expected 25 basis points. The rather tepid employment data out on Friday has given the Federal Reserve really less room to cut 50 basis points. So the smaller cut is more likely going forward, and this may not be enough to really prolong this rally much further. And then we feel that the scenario of that right-hand shoulder completion is more immediate. So we would still categorize this rally more as a relief rally on good news, trying to stem the fears that are and have been very prevalent in the stock market for the last few months. And we certainly feel it's not a continuing rally as part of the bull market of the last several years. We'll be watching the Federal Reserve's interest rate announcement very carefully this week. But until next week, it's goodbye from London.